Hi, how are you?
Hey, I'm good, Ashutosh.
So, thank you again for joining in. But I thought, I'm in Himachal right now and we couldn't connect face to face. So, I thought maybe let's just keep the conversation going. So, thank you for taking time out for this once again. And I think continuing from the conversations earlier, now this time around, we are going to talk about investment risk, which is the continuation of the conversation we have been having around what is investment management, followed by the research management side of it, and diving deeper into portfolio management, construction, and so on. And when we spoke about last, you mentioned that, the whole idea of portfolio management and construction is that there's this underlying sort of, layer of investment risk, which is like the sort of a holy grail of the overall process. So why don't we just start by maybe you giving a very simple understanding of what really do we understand by, are we to understand by the term investment risk?
Hey, again, thanks, Ashutosh, for inviting me again to these series of conversations. Yeah, investment risk, I mean, you rightly said, is the holy grail of portfolio construction and management. So essentially, for a very layman, it's just like any other risk, it is the uncertainty around the returns that you get, right? It is this uncertainty which can actually lead to a loss or underperformance against what you are expecting from, say, the money you have invested into different kinds of asset classes. That's a very simple term, a definition of risk in terms of when you're investing money.
So, so tell me this. So, the world is changing faster than ever, right? So there's technology, that there's geopolitical changes, and the very nature of the market themselves, right? So it all seems to be in flux all the time. So in this situation, how do we sort of manage risk in an environment that feels like, increasingly unpredictable?
I think the first thing to manage risk is to first really understand what risk comprises of, right? What exactly are the different, there's not one single risk you are exposed to when you are making investments. There are four or five different kind of risks that can come into, especially in the whole area of investments. So maybe let me just give you a very brief of those that we could encounter. The first one is the systematic risk, or what is also referred to as the market risk, which is essentially a risk that markets can fall across all the asset class. The whole market falls. You probably don't even have control over that particular downfall. There's something 4 years back when we saw when COVID-19 first hit us, almost every asset class, maybe barring gold, fell down. Probably didn't, as an individual investor, or even as an asset management firm, didn't have much control over it, right? It's system wide, as the name suggests. I think then the next is unsystematic risk, which where you typically try measuring the uncertainty about investment, say into a particular firm or a particular company, which you have much more better control of because we have done your research and your proper analysis. And that can be very easily mitigated by diversifying your portfolio, right? As people say, don't put all your eggs in one basket, right? Those are very typical two risks that you have in equity. Then you have credit risk specifically for fixed income markets, which is nothing but the risk that if you have any investment that you've done, it probably the third counterparty or the other party would default on it. You don't even get your principal back. Or the liquidity risk, the risk of not able to immediately liquidate your holdings. You cannot sell. What is the time taken could be much larger depending on the asset class. Or an operational risk, maybe not so much for investors, individual investor, but for large firms which run huge operations, anything with humans involved and a combination of machines and everything. Any operations fell down, like in case of settlements or delivery or whatever, you carry that operation. So there are different ways where risk, investment risk can come out. It could be a combination of one or two or all. So you really need to understand these risks before you start even thinking of managing those.
So that's very interesting. But so it seems like what you're speaking, the sort of underlying factors are, a lot of this data that's available to us and all the algorithms, and then, the platforms that are so powerful today and are almost available at our fingertips. But while we're looking at all of this, the systematic and unsystematic risks in such a scientific way, are we relying too much on the quantifiable aspects of it while we're overlooking the human element to it? I mean, I guess what I'm asking in other words is that, like, how do the behavioral biases can sort of lead to this disastrous decisions despite of all that we have access to?
Yeah, you're right, Ashutosh. I think there is a need to study both. Like when we're discussing portfolio management, we said it is a combination of both quantitative and qualitative aspects. I think similarly holds true for risk as well. I think you need to understand those systematic, unsystematic risks, understand the betas and sharp reference ratios of the world, the credit spreads, to understand the mathematical part, because that is end of the day also a risk that if you don't understand, you will not be able to mitigate. And in the last few years, the last couple of decades, when this behavioral finance theories have also come into portfolio management, there's also been a understanding that those also need to be studied when you are trying to understand the risks of investing, and people are trying to find, although I don't think there's still concrete measures on how do you measure it, but still a lot of theories have been tested. And there is an emphasis that you need to understand behavioral biases as well when you do risk management. So there is that uh, appreciation of that fact. But that doesn't mean you let go of whatever research has also happened on the quantitative aspect, because that is also something you need to measure and find ways of mitigating.
Right. So you're speaking about some of these, sort of risk measurement methods. Can you little bit unpack these in bit more details? When you're talking about systematic risks or unsystematic risks, what kind of ratios or error measuring techniques are we talking about here? Just a few
So I
examples.
think, yeah, I think so. All of this risk management also evolved when the modern portfolio theory, as we talked about last time, came into being. Probably the first very basic measure of risk is the standard deviation of your returns, right? It just measures the volatility of your returns. Like for a very simple thing, a fixed deposit where you get a constant return,
Mhm.
the standard deviation is zero, right? You're getting the same return. As the risk that you carry in different asset classes, the number increases. So you
Right.
probably get a high or a low as your investment horizon increases, and you measure the standard deviation. Very for a very simple variance. Then you get into more complex things like beta, where you try to measure the systematic risk, which measures your portfolio performance relative to the market. Beta of greater than one is considered to be better. Then you have models like VAR and Sharp ratios and those kind of ratios. We tend to measure your portfolio against your benchmark or the amount of risk you're carrying as a firm. So those are and a number that have been, and recently in the last few decades, a lot of big firms have got into risk management. They have built tools. You would have heard of Bloomberg Terminal building its own tool, Bara risk models, or BlackRock even coming with risk management tool within its Aladdin platform. So all of those have come with more sophisticated mechanisms of measuring risk, something which big firms can afford. I mean, this is not something uh, very expensive and not something a day-to-day person can do. But still,
Yes.
I think for a normal investor, diversification probably is the best way. But still, there are complex methodologies, something people need to get into details to before they understand, but they help you understand risk across different asset classes.
Right. So when we are talking about things like, the standard deviations or the realized beta, so basically essentially it looks like we're talking about a lot of availability of historical data for tracking. But then, but you're kind of trying to project the future in a sense, right? So what are the approaches when you're looking, when you have, historical data versus, when you're trying to look at something in the future? How does one look at this kind of the combination of
Yeah,
these two?
yeah. So you can do risk measurement both from a historical perspective to understand the performance as well as try and anticipate risk for a future in very hardcore financial technical terms. The historical measurement of risk is what we call as ex-post risk, and the future is something ex-ante risk. So ex-post is generally used to do performance management, how the portfolio has behaved so far with respect to their benchmark and how much the fund managers contributed. And the ex-ante is more of like the models I talked about, more technology coming, more kind of data, you try to understand, okay, with the kind of investment, where would my risk go? Does it fit in with my overall profile of returns that I want? So again, those two have very two different ways of in which they are used, but you probably use might just use a combination of both, because historical risk exposure helps you understand how a particular fund manager is performing, and that helps you make an investment decision whether you can trust your money with that asset manager. And ex-ante risk generally is used more by big investors, sophisticated asset management. So I don't think retail investors probably can get into that kind of mathematics. But yeah, these more asset management companies for their own internal controls that they have around risk return profiles.
Right. So essentially, there could be, example, uh, seems like there are 10 platforms, at least for the institutional investors, in terms of, whether they're trying to do a lot of data analytics or sort of a real-time monitoring of the portfolios, or whether they're trying to sort of do some kind of predictive modeling. But then, for the retail investors, is there a hope in hell? Because I think last time when we also spoke about it, we kind of touched on it briefly, saying that a lot of people who lose money in the market are essentially retail investors. So what's the advice for them?
I think one thing is definitely only do investments once you have done your thorough research. Don't just make investments based on tips or uh, intuitions. It's better always to invest in something you know. And like as Warren Buffett talks about this whole concept of margin of safety, right? You, uh, what he says is there's not a good or a bad company, there's always good or bad price, right? There could be a fantastic company, but if the stock price is already taken care of that, it's already gone beyond its intrinsic value, even it's a great company. If you invest, you're probably not going to make money. But try and always have opportunities where you think there is a margin, uh, there's still some intrinsic value compared uh, to the prices. The other thing
Right.
is diversify your portfolio. As a retail investor, don't put everything in one basket, and diversification, try diversify across asset classes, and also within asset classes, try to diversify across different instruments.
Right, right. So you spoke about Warren Buffett just now, but are there any other kind of legendary people who had this notable contributions that people who have interest in reading or want to look up, frameworks by reading books or on net? Are there things that you can kind of suggest people or recommend something for them to look up to?
Yeah, I think there's this guy Nassim Nicholas Taleb. I mean, he's done a lot of research around risk management and how uh, future projections can work out. I think generally most of portfolio construction and management focuses uses normal distribution as a basis. It generally focuses on, say, plus minus three standard deviations uh, around your average returns. But I mean, he brought this whole concept of black swan event, right? It
Yeah.
generally people don't think about when building their portfolios, the tail end of your distribution, where something drastically can happen and your whole portfolio can go haywire because you've never prepared for it. So yeah, these are people who have done those researches. There's some people who talk about building a portfolio based on risk only. You would have a Ray Dalio, who probably leads one of the biggest hedge funds, Bridgewater. So it again talks about a lot of around diversification again. So I think most of the successful fund managers, investors you will find, they would have very sound risk management practices, and it's good to listen to their podcasts or whenever they come out with their annual reports. I think these are some very basic, simple concepts. Just can you start adopting them in your daily investments?
Right, right. So whether it is through, I think the people that you're mentioning probably, so some of them probably, through the development of these theoretical models, or versus some of them who had these kind of innovative strategies, or whether they are just advocating for some prudent investment practices. Probably some of these probably, might give some good reference points
Yeah,
to.
and if you think if you read through most of these people and the literature, they always talk about that most of the people tend to lose money when they bring emotions
Right.
into that whole process, right? It's you end up buying when the stock is high and you sell it when it is low, right? That's the worst thing in but that's psychologically that's what people tend to do. It's all about momentum trading. When prices are going up high, retail investors tend to buy At that point, when it is going down, then you just in panic tend to sell your uh,
Right.
investment. In theory, you probably always should do the reverse, right? In any business, you'll always make a profit when you buy low and sell at high price, right? It's the same holds true for investment, just your psychological makeup, whether you
Right.
are able to follow your process, the investment process, and able to make it.
Right. And now that, with this sort of, I think every time we talk about it, we can't just leave the sort of role of technology and AI now, in this whole area. So what's your take on in terms of practice? Because it seems like some of these theoretical models and frameworks have been existing from quite a bit of time now. Has the landscape changed in, let's say, last 10 years, 5 years? Yeah, what's the outlook from a technology
I
perspective?
think risk management probably still. I don't think we've not seen much of AI there. I don't see because it's still more of runs on data, how you analyze it and come out with numbers. Yeah, but again, AI, I would say it's like people say for any software or IT solution is garbage in, garbage out, right? If the data that is being fed even to a risk management system is bad quality and
Yes.
the results also you will get is bad quality. So I think it's the quality of data that is fed into a risk management solution that is much more important. And I
Right.
feel real-time risk really doesn't hold much value, right? Because risk is not something point in time. It should be spread over time before you start measuring risk.
Right.
So, but yeah, it's more about those models, how much data they can process and come out with much better accurate measurements of risk. And there's a lot of research still going on. Like we said earlier, academics are trying to build in behavioral biases, ways to measure those and then quantify it also in
Yeah.
terms of risk.
And God
So
knows
those
how
is
many biases those fundamental models may have. So
right.
the jury is
But
still
I
out.
think it's a lot of experience that goes in. But again, I'll come back to the same. It's about how do you follow your process and are able to continuously learn from it and refine it.
Right. Okay. Okay, I hope that gives listeners a decent view of that risk is not like just one monolithic word. It's far more nuanced and probably something that you kind of integrate in your process as opposed to something that you purely avoid. Because a good investment strategy is largely about managing the risk. So on that note, Amit, thank you very much. I know we had less time today, but we can do this session next week while I'm there face to face in a week's time or so for the.
Thanks, Ashosh, and same to you as well. Enjoy your holidays.
Thank you. Thank you. And look forward for the next conversations around trading and attribution and related topics. So stay tuned. Goodbye.